Welcome to The Pulse with Lauren Bango, a DLL podcast series. This is your place for tips, trends, and insights into the world of healthcare finance. Now, here's Lauren.
Welcome back. We are joined today by frequent guest John Plantier, otherwise known as Johnny Finance. Welcome back, John. It's been an interesting month or so, or a few weeks. How long's it been since we last spoke?
Yeah, it's been a while. How you doing, Lauren?
I'm doing great, thanks. Did you have a good Memorial Day weekend?
It was phenomenal. A lot of hot dogs, hamburgers. Squeezed in a little bit of golf there too. So yeah, can't complain. What about you?
It was a good weekend. Lots of fun, family, a little bit too much sun, but that's okay. That's okay. So now we're digging in. Now we had all the fun, and we're gonna dig in. Let's talk about the Fed meetings. We're probably nearing up on the June meeting, and I know some of the data that they're gonna use to look at the rate hike is coming out, but I know in May we saw the Fed raise rates another 25 bips, and I know that recently we saw the PCE come out. We've seen some other data. So what should we be watching?
Yes. So we are in a very interesting time where there's a lot of negative pessimism about where the economy is, but the reality is some of these indicators are showing that the economy is very strong, incredibly strong. When we talk about the personal consumption expenditures price index, which measures, okay, what are people consuming and at what associated price? It looks at GDP data, all right? And the Fed, this is their preferred measure as to how to gauge how hot inflation truly is. And that went up by 0.8%, right? So prior 2 months, it was nearly flat, and that number has ticked up. Now, personal consumption expenditures, there's also the core personal consumption expenditure. We call that the core PCE. And that went up by about 0.4%. Now, the difference between the PCE and the core PCE is the core PCE removes out food and energy associated costs. And that's really the best gauge for the Fed to see how inflation is measuring against on a month-to-month basis.
And why do they remove food and energy?
They remove food and energy because food and energy over time has shown that there's a lot of volatility with both of those verticals. So in the Fed's view, the best way to really gauge how inflation is tracking is to remove those out. An example of that could be something like the impact of the Ukraine war, where you saw energy costs absolutely skyrocket, right? There's so much volatility with both of those that it's best that the Fed says, you know what, that doesn't really give me a true baseline because of that volatility. I want to see what's going on even on a more granular level.
Got it. That makes sense.
Yep.
So now we have the core PCE. Anything else that's coming out that we're waiting to hear about? And
yes,
what do you think's coming?
All eyes on the jobs report now. So with going back to the core PCE, because of that increase here, if you were to go back to the last Fed meeting where Powell was saying flat out, he goes, hey, we might not be done here. The economy is very strong. Well, future traders were saying, we don't think you're right, Powell. Even though you're saying that we're not going to increase rates anymore, we're betting that we think you're done for now, at least for the upcoming meetings. And now you fast forward to this core PCE number and the PCE number, and we'll see what happens with the jobs report. But it's looking from an odds perspective that there could be an increase at the upcoming meeting. So if the jobs report comes in better than expected, it's very likely that the Fed could in fact increase their target to about 5.25% to 5.5% at the next meeting. So it's fluid.
Got it. And so what is expected in the jobs report? What am I watching for?
We're seeing how robust the economy is. If you go back a couple of months, we don't even have to go back too far, where all the talk was recession, recession, recession. It's just a matter of time. Well, now everyone's saying we got some time until this potential train might hit us. Lauren, rule of thumb is you can't have a recession when the job market is as robust as it is right now. So with the unemployment rate being as low as what it is, around 3.6%, and if the jobs report continuously shows improvement and addition of jobs, it's very hard to say that a recession is inevitable. And so what we're looking at there to see is just how strong is the economy from a jobs perspective.
Thanks, John. I know we've talked a lot about the June Fed meeting and the data that we should be watching in advance of that meeting. In the same time, there's a lot of discussions happening right now regarding the debt ceiling. I know there were a lot of updates over the weekend. What do we need to know there?
Yeah, so all eyes on Congress now. President Biden and Speaker of the House McCarthy, they came to terms over the weekend, and the bill now goes to Congress. Hopefully, it's all political theater and a default, which is what would happen if we didn't raise the debt ceiling or come to terms on the debt ceiling, would happen, which would be absolutely catastrophic. So all eyes on Congress to pass this bill to increase the debt ceiling. And the more time and hours that go by without an agreement, I mean, there is some concern, but much less than where we were at going into Memorial Day weekend.
Okay. Well, that's good.
It is very good news. Well, let's see. It still has to get through Congress here. And as we know, with this political environment, anything could happen.
So we've talked about the Fed meeting. We've talked about the debt ceiling. We still have some unsteadiness in the regional bank space from what I see. What we also are seeing a lot of our hospitals and medical customers, healthcare customers, freezing or changing their capital budgets. This is impacting their ability to buy the equipment they need. They're delaying that purchase with all of this craziness going on. Do you have any suggestions for our partners who sell into these healthcare facilities on what they should be thinking about?
I do. So there's been this common theme with the increase in rates that we've seen in the market, where that you've heard me talk about the shock and awe impact, where a lot of our customers said, hey, I'm so used to financing with very cheap money, and now rates have gone up, so why don't we just pause and see what's going on here? And in the hospital space too, it's been very common to see that because of the costs associated with COVID when it comes to your labor costs that went up. Well, those labor costs are still there, but the revenue associated with some of the services that the hospital is providing is not there. So your OpEx, your operating expenditures, have increased there. So many hospitals have said, let's just take a break and assess our capital situation. But there are ways around this, right? So structuring agreements as service agreements can often give the treatment for our customers to either bypass certain approvals that need to go in front of the board. There's potential for off-balance sheet treatment. There's a variety of ways that a service agreement can help ease some of the concerns, as opposed to making it read as a true, let's say, capital lease type of structure. So that's one way. The other way to do this is also a trade-up of an existing agreement. So if you have an agreement already in place, you could look at that agreement and say, is there the ability to upgrade that equipment or attach on to that equipment, which also will allow certain hospitals to say, well, look, we're not entering into a new agreement. all we're doing is adding on or updating or upgrading our existing agreement that we already have in place. So those are two common ways to bypass some of the capital objections that we're dealing with.
So smart. And so the service contracts, that's something we set up ahead of time, right? So for our vendor partners to use. So something that if that's of interest, you should get in touch with your program manager and let them know that you'd be interested in offering that.
Yes, these agreements can be quite sophisticated, and no two are the same depending on the needs of customers, and the structures of these can be quite complex. So they do take time, and getting in touch with your program manager or whoever handles the product development side from us will truly be able to put down on paper as to what this structure, what this program could look like. So yes, timing is critical there, and it does take some time to put these right products in front of your customers.
Awesome. Any last words of advice before we let you go?
Yes, I would say in this environment of the market being as fluid as it is and the constant changes, this is where product development becomes so important, and staying close to your financing partner to work on special solutions that fit your customer needs is really where we're going to shine here. So taking the time and effort to explore new options, staying close to not only the customers, but also working with your financial specialist to make sure that you have the right product in front of your customer in a fluid market. That's the best thing you can do.
I get in touch with us often and early.
If I recall.
Awesome. Well, I am sure we're going to have you back in another couple of weeks to go over what happened at that Feb meeting, but I really appreciate you taking the time.
Absolutely. My pleasure. Thank you, Lauren.
We'll talk soon. Bye-bye.
Have a good one. Bye-bye.
Thank you for listening to The Pulse with Lauren Bango, a DLL podcast series. The opinions expressed in this podcast are solely those of the participants. Nothing herein should be construed as legal, tax, accounting, or investment advice. Join us again for the next edition of The Pulse. And thanks again for listening.